Hey guys, good morning. It's Angelo Christian Financial. Thank you so much for watching Real Estate Insider, our podcast where America goes for funding for the last 20 years. Call or text our office. Today we're talking about debt ratio. A lot of people, a lot of lenders, a lot of people don't talk about debt ratio, but it's one of the key things to know when you're getting a home loan. And what debt ratio do you need? That's the question. A lot of people, they apply for a loan, they're not prepared. And sometimes their application gets denied because their debt ratio is too high. So it's very important that you know what debt ratio is, number one, and then what debt ratio do you need when you're getting a mortgage. Okay, I don't care if it's commercial, I don't care if it's investor, I don't care if it's your primary residence. All lenders are looking at debt ratio. Now, there are some programs where there is no ratio requirements, but we're not talking about those today because most programs do require some sort of debt ratio because debt ratio is the ability to repay. If you have too much debt, then you can't repay the loan, right? So every program, for the most part, has a debt ratio requirement. There's a housing ratio, which is your house payment relative to your income. And then there's a back-end debt ratio, which is your total debt ratio. That's your house payment plus all your debts over your income. And lenders are looking at these. So it's very important that when you're getting a mortgage that you know what those ratios are, okay? Like, for example, with VA loans, the maximum housing ratio, the house payment that they want you to have is below 45%. So they don't want your income to be with your house payment more than 45% of your house payment. So if you make, $5,000 a month, what the VA is telling you is they don't want your house payment to be over $2,250 per month, right? And the same thing with FHA. FHA has a maximum housing ratio of 45%. So FHA and VA mirror the same thing. Now, conventional is different. Conventional and USDA, the maximum house ratio they want you to have is around 30%. It's a more conservative, more strict loan. So they don't want your payment to be more than $1,500 a month. Okay? So you have to be mindful of that because, you can't think that, like I had a client, the other day, she makes $70,000 a year and she wants to buy a $700,000 home. And I sat her down and said, look, if you want to buy a $700,000 home, we want to help you to make that happen and help you get there. But if you're making $70,000 a year, the most you can probably qualify for is maybe, $400,000 to $500,000. $700,000 is going to be a stretch unless you bring in more income because your housing ratio is going to be 60% if you buy a $700,000 home. So I had to, educate her and help her. So it's important that you understand the housing ratio and then the back-end debt ratio. Like FHA, the maximum back-end debt ratio is 56%. That means all of your debts, your credit cards, your car payments, your student loans, plus your new house payment can't exceed 56%. The VA is more liberal. The VA will allow you to go up to 60% back-end debt ratio. Conventional and USDA, the maximum they're going to allow is like 43%, maybe 45%. And jumbo. So it's important that you understand what debt ratio is so that way you can be successful when you apply for your home loan, you can actually get approved. And maybe you need to pay off some debt in advance so you can get approved. Remember, we're a nationwide commercial and residential lender for over 2 decades, helping hundreds of thousands of people serving America. That's why we're here. So call or text our office at 832-431-6331. It's where America goes for funding. Thank you so much for watching my video and check out my next one.